China. China could ironically turn out to be a more defensive investment play than the developed markets amidst COVID-19. It all comes down to China's success to date in containing the virus. China's COVID-19 curve has flattened while US and European curves are still running steep. New cases in China since the start of April have been kept at or below 100 per day. This compares to over 15,000 at the peak in February. In the United States, it has been running between 25,000 and 34,000 per day since the start of April. The upshot of all this is that China is returning to work, albeit slowly, while the rest of the world has shut down. Traffic congestion in major cities is back over 80%, and in some cases, over 90% of pre-COVID-19 levels. Large industrial companies' work resumption rate has been estimated at over 90%. Pollution levels have also been estimated at over 90%. China's manufacturing PMI has rebounded from deep contraction in February to a growth reading of 52 points in March. It should be said, though, that there is always that risk of a second wave of infections, as there would be anywhere else in the world. But what China has demonstrated thus far is that its command and control system is far better equipped to deal with a pandemic than most others. And China has more policy ammunition as well than most others. Its fiscal stimulus has so far been modest at 1.2% of GDP, compared to the 10% of GDP committed in the United States. The People's Bank of China's reserve requirement ratio is still at 12.5%. In contrast, the Federal Reserve has just reduced its reserve requirement ratios to zero. On this policy front, that's as far as the Fed can go to encourage banks to lend. The Fed has also taken its policy interest rate to zero. Meanwhile, the PBOC is still sitting on a significant amount of potential interest rate cuts, with its loan prime rate at 4.05% and its medium-term lending facility rate at 3.15%. Relative valuation had long favored Chinese equities over developed market stocks, but they always lacked a catalyst to turn that into outperformance. However, with developed markets in COVID-19 driven economic turmoil, selected Chinese assets could turn out to be safe havens. An example of this is China government bonds. The spread between the 10-year China government bond and the 10-year US Treasury has widened to over 200 basis points from around 130 basis points at the start of the year. This recently prompted the Financial Times newspaper to describe China government bonds and so-called policy bank bonds as sanctuaries from volatility. The Shanghai Composite Index has been through a long cycle of underperformance against the S&P 500. Ironically, that underperformance started to reverse from February of this year. To repeat, there is a risk of a second or even third wave of COVID-19 infections. But Chinese stocks have the advantages of cheaper valuation, a very tough system of controls to maintain or to contain future outbreaks of the virus, and more policy ammunition than the United States. As markets stabilize, this could be a bargain hunting opportunity for long-term investors. As always, stay safe, stay well.